We have been seeing market strength across the board. If you take a look at how equities are performing right now, really hanging on to this life raft that Federal Reserve officials have thrown investors, even as producer prices have come in hotter than expected this morning. We're going to get Federal Reserve minutes this afternoon and a read of CPI tomorrow. Against this backdrop, we are seeing some deal flow. Spin Master, one of the best performing stocks on the TSX right now, as it buys wooden toy maker Melissa & Doug for an eye-popping $950 million US. It's the biggest deal that Spin Master has done by a mile. Their last large transaction was in 2016. And it was just for $85 million. Fast food chain MTY, also a strong performer today after it blew past expectations. Bottom line growth came in well above expected. It also delivered top line sales beat driven by a lot of acquisitions over the past year. Speaking of acquisitions, ExxonMobil is officially pulling the trigger, buying Pioneer Natural Resources. It's an all-stock deal valued just south of $60 billion at $253 per share. Well, that was based on Exxon's pricing yesterday. It is just a modest premium, but remember, news of the deal leaked out last week. It's the biggest acquisition by Exxon since it merged with Mobil in 1999, and it's the largest takeover this year. A new study of Ozempic, the diabetes and weight loss drug, wonder drug, I should say, shows that it was highly effective in treating patients with chronic kidney disease. So you're seeing shares of Novo Nordisk and Eli Lilly, which makes a rival drug, trade higher on the back of this new type of usefulness. But companies that sell products or services for kidney care are plunging. Check out shares of DaVita, providing kidney dialysis. Those are under pressure. Shares of Baxter, which makes medical devices and has a substantial renal business, also under pressure. The Ozempic disruption continues. Now, here's a look at some of the other top stories we're tracking for you right here in the BNN Bloomberg newsroom. Energy investors are taking a wait-and-see approach. I'd love to bring in Amrita Sen. She's the founder and director of research at Energy Aspects. Amrita, thanks so much for joining us. It's my job to ask you questions, but I'm curious, as somebody who, has the pulse of this sector, when this war broke out, what kind of questions were you fielding?
It's a great question, actually. In terms of the questions we've been getting is really around what are the risks of escalation over here? What are the possible impacts on oil vis-a-vis Iran, right? Because in terms of what is the very unfortunate events that are going on, they don't have a direct implication for oil unless and until Iran gets involved. So will the U.S. potentially scrutinize the volumes that are coming out of Iran? Are there risks around potential attacks on their facilities? So those are the questions that clients are asking. I would say the answers to pretty much all of them is that, look, the direct impact on oil is very low from this, oil supplies, I should say. However, you can, with any geopolitical risk, you can never say the probability is zero. And that's why a lot of investors are looking to position on the long side via option markets, just having something on. I do think the sell-off we've seen right now is, it's not justified with either the fundamentals or what's going on geopolitically. Sure, we can continue to go down a little bit based on positioning, but ultimately we do think prices should be headed higher. And
while the direct impact, to your point, is not immediate or a big change for the supply side, am I right in characterizing that the risks of the direction, things could move with respect to Iran, with respect to Saudi and U.S. relations, the risks are tilted to the upside for oil prices?
I mean, look, there was a lot of chatter around Saudi Arabia potentially bringing back production because of the diplomacy going on between Israel, U.S. and Saudi Arabia. That was completely unfounded to begin with. I think what's going on now in the Middle East puts those speculation to rest. There's a real chance that the talks could even get derailed, right? So all those factors need to be considered when you are making the call on oil prices. Fundamentally, though, inventories are extremely low everywhere in the world, and that does mean oil prices should have a higher flow. The opposite side of it, of course, is the macro environment, be it the US, just generally OECD countries. The macro isn't great with higher interest rates, and that's what has been the drag on sentiment of late. But I would argue that's not new, right? We've been through this kind of recessionary environment for some time. And I think that's the tug of war we're playing right now. Very strong fundamentals versus a relatively uncertain macro.
I want to get to that in a second, but first I want to go back to something you said, excuse me, that the prospect of the U.S. and Saudis coming together for a deal, that was always sort of a pipe dream, because there were many who came on the channel who said this is a real material downside risk to energy. It sounds like you never felt that way.
No, because oil was never a part of that deal. We have direct, line, whether it be to the Saudi ministers and also to others who are involved in the conversation. And the deal, of course, the deal was progressing, diplomacy was progressing, but oil was never a part of that. So yes, there were lots of media headlines around it, but they were completely unfounded.
Now, to your point about concerns about a slowdown, we just had the IMF come out once again, cutting growth forecasts. But it's a similar setup to what we kind of walked into in January of this year, right? Growth forecasts were being cut. The expectation that a recession was showing up. It hasn't. But, 2024, if it's going to show up, wouldn't you think that that's the year?
And this is why it's almost like this recession has been coming forever, right? Even late last year, people were talking about the recession, and it's almost like, okay, let's get on with it. Either we are in a recession or we're not. It keeps hanging over the market. Yes, now everybody's pushed it back to 2024. Look, yes, with higher interest rates, we do think there's a real risk of slowdown. We've already factored that into our prices and our balances. We've got global oil demand slowing down to about 1 million barrels per day of growth versus over 2 million barrels per day this year. We've got, one of the big reasons why we have, for instance, product prices coming off next year is because of that. For me, this is not news. I guess the challenge is if the market is worried that higher oil prices forces the Fed to continue raising rates and the recession isn't mild, it could be deeper. But again, it's too early to say that. Oil prices aren't even very high right now. But I think that's the fear, and that's what we're dealing with right now.
Is $100 in the sight line for oil, West Texas?
I absolutely think that's still on the cards. I mean, look, short term, you are bound to get volatility. It's never going to be move is never going to be in a straight line. But ultimately, I do think we do see triple digit as long as inventories stay as low as they are, and demand is still okay. It doesn't have to be great as long as it's kind of holding up. We still think triple digit is on the cards this year.
And what does the deal between Exxon and Pioneer tell you about corporate confidence in the sector and the assessment of market conditions?
I think it's much more, tells you a lot more about the U.S. shale industry and the consolidation we've seen and continue to see. Very much focused on the best acreage rather than growing at any cost. That was the shale mantra last decade, where returns were never a priority and it was all about production growth. Now that has changed. You are seeing far more kind of concentrated growth, better quality acreage only being exploited rather than any random piece of land being drilled. And I think that is really here to stay. But the biggest implication of that is that it means shale production growth, or U.S. production growth, is going to be slower. And it is going to be more sustainable. So next year, we've only got 300,000 barrels per day of U.S. crude production growth, which is going to be one of the slowest we've seen outside of COVID.